Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Wednesday. It's the Hump Day edition of the Real Investment Show. That means Danny Ratliff's joining me this morning. We're talking a little bit about private alternative investments today as it relates to retirement income. A lot of other stuff to get into this morning with him. So we'll kind of get into all the nitty gritty here in a few minutes. But of course, the markets are going to open a little bit lower this morning after rallying a bit yesterday. Of course, a decent day yesterday in the markets overall. I've had a couple of good days on kind of the markets recovering, and again, we had that sell-off on Monday because of the whole trade war situation. If you haven't read our article yet, we put an article on the website talking about the tariff royal yesterday, and that's up there talking about technically where the market is based on these tariffs. This morning, in the daily market commentary, I posted, I'm going to go through these charts with you this morning, but I posted 3 charts this morning in the daily market commentary, looking back at President Trump's first term and how markets were responding on both the volatility as well as the market itself over that 3-year period that we were in the middle of this trade war with China. Again, so these are important points of context because we don't really have any previous history on tariffs until we go back to 1915. So there was no tariffs for a very long time, and so really the only thing we can look back at in recent history is President Trump's first term with tariffs and how the markets responded and try to determine what that means for the markets as we head on into the rest of this year. Also had some big earnings last night. Google missed a little bit on revenue. Again, we're talking about a few cents on revenue when you're talking about billions of dollars. You know, it's kind of interesting how markets respond. But Google's been down pretty sharply this morning, down about 5-6%, coming off overbought conditions, all-time highs for the stock. So a correction was going to come anyway, and the earnings announcements yesterday really not that big a deal. Ad spend is doing very well. Ad revenue is doing very well. Little bit less than overly optimistic expectations by Wall Street, but again, we're talking a very minute miss. But again, the markets needed a reason to correct. AMD also had very good earnings last night. They beat on revenue and earnings all across the board. Very good numbers. That stock is also going to be down this morning, though. A little bit light on their data center revenue, but very marginally. But still strong growth there. Outlook was good. CapEx spend by Google is going to increase fairly sharply this year. So money still being sent into that space. But AMD's been under a lot of pressure lately. They're kind of flirting with very important levels. That stock needs to recover here today, as a matter of fact. So when the stock opens today, it does need to start to recover from those lows. If not, we'll have to see what kind of happens from there. But overall, earnings have been pretty much in line, but expectations are coming down. Wall Street analysts are starting to cut expectations for earnings growth because of what's going on with tariffs. That's not surprising. But again, this is all kind of just weighing on markets. So the miss yesterday by Google and AMD in particular. Apple this morning is down about 3% at the open. Pressure from China, who said they may, again, this is part of that trade war that's going on. That we're talking about a 10% tariff on China. China's kind of come back with other measures, and it's kind of this tit for tat positioning before negotiation happens. So they're now saying, well, we're going to have to investigate Apple a bit here. They just did that with Google the other day. So China's kind of picking on the Mag 7 in particular, these big companies that have business in China, picking on them for investigations. Oh, we're going to have to explore this. We're going to have to investigate it. This is just positioning ahead of trade and tariff talks with President Trump. So again, just don't read a whole lot into this, but markets are going to take this a little bit this morning. Markets are going to open down about 0.5% or so right now, at least at the open. A lot of that's going to be in the technology sector, basically some hits there. But overall, markets are doing okay. We still have been kind of struggling with support levels, and let's talk about what you need to know before the bell. So markets again, yesterday had a nice rally, got back. We had broken on Monday. We had broken support at the 50 and the 20-day moving average. So that was kind of an alert, and I said, hey, don't do anything on Monday, was our Monday's advice. Just go play golf, go fish, go do something else, just turn off the media for the day. And the market opened well below those moving averages, but rallied back up and closed right at the 50-day moving average. Yesterday, we rallied above that, got above those resistance levels. The 20-day moving average is about to bullishly cross above the 50-day. So that's suggesting that the market is still trending, and we're still doing fine here in terms of a perspective. Money flows are still coming into the markets fairly well. Now this morning, we're going to open back down, close to the 50-day moving average support. So markets need to hold today right around that 50-day moving average. We need to hold that support if markets are going to continue to try to push up. Now this rally yesterday, we were very close to triggering a MACD sell signal. Now we may do that today. If the market closes lower today, we're likely going to trigger a MACD sell signal from a kind of a middle-ish level. So there's not a lot of downward pressure in the markets from here. But yesterday, this rally kind of kept us above that cross at this moment. So again, we're still kind of on a bullish buy signal right now, but just flirting with it. I mean, it's very close. And we're about halfway through reversing that overbought condition that we had following that post-inauguration rally from the market. So all that's going on here with the markets, again, a lot of volatility. I'm getting a lot more questions lately. It's like, oh man, this market's just not really doing much. It's just, kind of all over the place. It's weighing on me. If it's weighing on you, you've got too much risk in your portfolio. So this is when we go back to talking about rebalancing risk, reducing allocations, make changes as needed. Some stocks are working this year, some stocks aren't. So maybe revisit kind of what you own and why, rebalance those positions as needed. But again, we're just working through right now this whole consolidation that's been going on now for the last couple of months. It's been this sideways grind for 2 months now. Market really hasn't gone anywhere. Lots of ups, lots of downs, exhilarance, exuberation, depression. So we get all wrapped up into these day-to-day movements, and this is why it's important just to step away, turn off the media, go do something else. Let the portfolio just kind of work and do it. If you've built it right and it's diversified correctly, this shouldn't be hurting you too much. It should just be, just kind of grinding along sideways with the markets. No big gains, no huge losses. You should be okay. But again, just kind of moderate this. Again, if we go through a sell signal here, which isn't going to be surprising, if we do that, February tends to be a weaker month anyway. We potentially get a correction that brings the market step back down 3-4%. That'll probably line up to provide you a decent buying opportunity if that happens. So again, we just have to kind of work through that. We're still in the midst of earnings season, still grinding our way through that right now. We've got about another week of this before we have the majority of S&P 500 companies have reported. Then the buyback window opens up about mid-month. So around the middle of February, most of the corporate stock buybacks will be back in action for the market. So that'll help provide some support as we get into March and April and start heading into kind of the end of the seasonally strong period. Now, outside of that, one thing we're paying attention to, and again, this is all going to relate back to what's going on with President Trump, is paying attention to the dollar, because the dollar is a function of monetary tightness or monetary looseness. And so the dollar has been weakening here lately. That's what's helping provide some support to the markets here near term. So if the dollar does continue to weaken, that should help provide some monetary easing for the markets and help lift stock, keep a little bit of a bid underneath stock. So keep a watch on the dollar. Tells you a lot about what's going on right now. And again, this is all kind of coming back to this whole trade and tariff and what's balancing those currencies with other countries like Canada, China, Mexico, etc., the dollar is going to really kind of be your lead indicator here to watch, at least for the next couple of months. That's what you need to know before the bell this morning. When we come back, we'll pick up Danny Ratliff. We'll talk about those charts during President Trump's first term and what that may be telling us about the markets over the next year. And we'll talk about why when we come back. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you thought retirement income was just stocks and bonds, let us help you understand how to rethink your approach. Our first Candid Coffee of 2025 has everything you wanted to know about income in retirement. Saturday, February 8th with Richard Rosso and Danny Ratliff. What else is there besides stocks and bonds? Is your retirement paycheck really diversified? Everything you wanted to know about income in retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show. Welcome back to the show this morning. You good? Yeah, we're good. Okay, just checking. Danny the Bulldog Ratliff back from his book signing tour.
Hello.
He's been gone for the last week or so. How was it out there?
Been fantastic. Thank you guys for all the support.
Were you mobbed at the bookstore signing your book?
Nah, nobody's gonna mess with me. Kidding me? I just take my shirt off. It's all good.
Speaking of, we have new shirts coming, so I'm very excited about that.
We'll see.
We'll see. Are you the budget czar on the new shirts?
Budget czar, yet skeptic, yet. And I'm pretty optimistic in general, but it seems like whenever we get new polos, it's, not as advertised.
Yeah, exactly.
You can feel them, you can see them, and then you get them, you're like, is this the same shirt?
But I went through all the shirts this time.
I did as well.
Okay, good. Did we pick the same one?
Yeah. The one you're wearing, we picked too, and nobody likes it either.
It didn't turn out well.
Yeah.
I know. All right. Well,
The financial fashionistas.
Exactly. Mm-hmm. Just trying to get there. Anyway, we got a lot of stuff to get into with Danny this morning, but before we get there, I wanted to just run through a couple of charts. I'm getting a lot, I'm sure, Danny, I'm sure you're getting a lot of charts about tariffs and questions about tariffs and impacts to markets. So I put together some charts. I saw some really good charts. These are not my original. I didn't come up with this, but there were some really great charts out yesterday by Deutsche Bank. So I recreated a couple of them and added to them a bit, but they were just a really good piece of analysis about tariffs. And again, like I said, when we go back, we don't really have much history to work off of in terms of markets and tariffs. Back from 1915 to about 1940, about 80% of the tax revenue collected by the country was excise taxes and tariffs. Only about 20% came from income taxes. The average income tax rate was around 5%. We now tax everybody domestically to create revenue, and we don't use tariffs anymore, except the only other time outside of that was during President Trump's first term when we had the trade war with China. So the only real, kind of period that we can look back at and say, okay, here's a precedent that we have to work off of, and kind of how did the markets react, and what was, the issues that were going on there. And there's certainly some differences between now and then. Example, and Brent, you're going to bring this chart up and just leave it for a moment because there's a lot to kind of go through here. But this is a chart of the S&P 500. This chart starts on December the 1st of 2016. And the reason I picked December the 1st is because he was elected November the 5th of 2016. So he just basically not even in office yet. So he got, his inauguration was January the 20th of 2017. So I started this in December just to kind of show us where we were. And we had, of course, as he came into office, we were passing, he was talking about tax cuts and deregulation. He was working on that. In November and December of 2017, he passed the Tax Cuts and Jobs Act. And that's where you see this big spike in the market going into January of 2018. And so everything's great, right? We've got tax cuts. It's going to be awesome. Company, everybody's piling into the stock market because this is going to really boost earnings. Then he says, oh, by the way, we're doing a trade war. So we have this sell-off. So over the course of the next 18 months, the markets are basically range-bound. Lots of volatility, big rallies, big declines as these announcements about tariffs and the trade war, 10% tariffs on $300 billion worth of goods, Chinese tariffs, they retaliate by, 25, raised to 25%. China retaliates on us. But the market's held within a pretty big, broad trading range. And so despite all this volatility, now that big sell-off in the middle, that was also where the Fed was hiking rates. So we've got the Fed hiking rates, which we don't now. That is a difference today. The Fed's not hiking rates. They're actually cutting rates. They were hiking rates then. And remember, this is where in December of 2018, this is where President Trump and Jerome Powell were in the spat with each other. And hey, we're going to, I'm going to fire you. And that was the whole big debate. And then, of course, quickly with that 20% decline, the Fed comes around and says, oh, yeah, I think you're right. We don't need to hike rates anymore. And by June of the next year, they're cutting rates. So then the market starts taking off again. So again, the takeaway here is prepare for some volatility. I've got one more chart. I've got two more charts to show you. Just try to put this together for you. Danny, bear with me just 1 second. This is the volatility index. And when you take a look at volatility index, this is potentially what we may be setting up for, which is a period where we, depending on how this goes, again, this is very early. We've had just a couple of shots across the bow with tariffs with Mexico and Canada and Colombia, and those were all resolved within 10 hours. What goes on with China, we don't know yet. What ultimately happens with tariffs, we don't know yet. But these announcements of tariffs and the impact of those, the retaliation, etc., all led to a lot of volatility, but these bouts of volatility quickly subsided as markets came to grip with the reality of what the tariffs were going to do. And again, we talk about consumer choice. We talk about, other things that go on, a lot of expectations. We're going to have this massive surge in inflation. It didn't occur. And so markets very quickly calm back down again, and volatility returned and markets continued to rise. So let's put all this together real quick. This is a chart of the S&P and volatility. And what we find out by looking at this is that during periods where there's a lot of action going on tariffs, you have these spikes of volatility, the market sells off, and then it's a buying opportunity. So rather than a lot of these media headlines like tariffs are going to destroy the markets, they're going to destroy the economy, that wasn't that. All we have to work with is this set of data right now for the most part, and that's not what happened. What happened was that these tariffs led to buying opportunities in the markets. And so, again, increased volatility. And this is why Danny and I have been talking a lot this year. I just wrote an article earlier this year, kind of, take off Larry David's Curb Your Enthusiasm, that
expect a year after 2 years of complacency. It was really easy the last 2 years to manage money. Markets didn't do a whole lot. They just kind of went up. You made 20% a year. It was great. Expect this year, because of what's going on, all these changes to the government, a lot of good things are happening, right? There's also some negatives from these. Deficits, you're reducing the deficit. In fact, in our daily market commentary today, they've added to the debt clock a doji clock, which is now tracking the billions of dollars that are getting cut from spending. Well, that's great, but that's also a negative to the economy. If we're spending less money, that's less economic growth. That's going to slow economic activity. So while there's a lot of good things happening financially, fundamentally, et cetera, but there's also potentially some negative impact. So expect a year. And I think that, this issue with tariffs and President Trump's first term suggests that we should expect a year with more volatility, but that volatility is also opportunistic to take advantage of markets, not go hide in cash and just, kind of miss out on the opportunities when they pass.
Yeah, and I think the bigger aspect here is if we go back, you can actually look at a lot of different studies have been done from 2018 and 2019 as far as what that overall impact of tariffs was. And if you go back from a GDP perspective, the impact was negative 0.2%. Mm-hmm. Now, that's on the tariffs that we had. Retaliatory tariffs were down. It was essentially less than 0.05. And if you think about the markets mm-hmm. down 6% in 2018, up a little bit over, 28 in 2019. Mm-hmm. So it kind of glossed over it pretty quickly.
Yep.
And the impact, though, so, I don't know what the right word is, maybe disingenuous when we keep hearing all these things that suggest that how bad it really is. Now, it could be worse. And, you hit on a couple really good points as you start really decreasing the spending. That can hurt.
Sure.
But also if the retaliatory tariffs are much more, that can be impactful as well. But we're not there yet. And as you wrote this week, you said, look, it's a stick and a carrot. Mm-hmm. And that's what it is. I mean, so far, there's really nothing that's been done outside of getting people to the table, having productive conversations, and actually getting them to do a little bit more than what they've been doing.
That's right. And again, there are some. I don't want you just to walk away from this conversation and go, oh, well, Lance said everything's fine. It's just going to be kind of a volatile range, buy every dip. There are some differences. Valuations are a lot higher than they were in 2018, 2019 in the markets. We are in the process of cutting rates, but inflation is higher now than it was, not substantially higher. We're about 2.9%. Inflation back then was around 2.2%. So, but inflation is higher than it was before. So we have, this kind of concern over inflation coming back. But inflation is not that much higher than it was back in 2018, 2019, but it is a bit higher. So there are some differences that could impact markets. So don't walk away from this conversation just going, oh, everything's fine. My point is very clear, is that you need to potentially prepare for markets that are kind of all over the place for the next year. Like we have a 5% decline, an 8% rally, a 10% decline, a 15% rally. And at the end of the day, you don't wind up much of anywhere, but you've kind of been all over the board. And that's kind of what we saw previously. And I think that's a reasonable expectation. So the point is just simply, make sure your portfolio is positioned for that type of an environment. And if markets just wind up going up, you should be fine. But if not, you at least want to have a little bit of hedge in place just in case.
Well, and even that negative year, that was based on Powell hiking interest rates in October because we had the Tax Cuts and Jobs Act that went so well with corporations having a lot more money on the books. And, we saw that all dissipate pretty quickly in Q4 of 2018. That was not on tariffs. That was based on interest rates.
That's right. So, all right, got a lot of stuff to get into when we come back from the break. The bond market's talking about some things about Trump's second term and also retirement income. We'll talk about that. Make sure you are registered for this weekend's upcoming Candid Coffee, where they're going to talk about generating retirement income. Danny and Richard do a great job on this. Something you certainly don't want to miss. You can register at the website right now, realinvestmentadvice.com.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you thought retirement income was just stocks and bonds, let us help you understand how to rethink your approach. Our first Candid Coffee of 2025 has everything you wanted to know about income in retirement. Saturday, February 8th with Richard Rosso and Danny Ratliff. What else is there besides stocks and bonds? Is your retirement paycheck really diversified? Everything you wanted to know about income in retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
One thing that the consumer confidence measures, is that correct? If I say consumer confidence measures?
Measured squared.
How many measures can the consumer confidence measure? I don't know.
The Real Investment Show podcast.
Dr. Seuss.
The consumer confidence measures investor sentiment about stocks. That's the highest level on record.
Same show, your schedule.
It's amazing. Consumers are super confident about the stock market.
At realinvestmentadvice.com.
At the same time, they go, my life sucks economically, but the stock market, it's all good.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. I want to be, just real quick, there was a headline on Bloomberg just a second ago, and so I just quickly pulled the article. I want you to be really careful, and this is what we talk about on the show. The media puts out headlines in order to get clicks and views, right? But it doesn't always tell you the real story. And there's one out this morning. AMD tumbles after giving disappointing outlook for AI growth, right? That's the headline, right? It's like, oh my gosh, I need to read this article. That's not what they said at all, right? Their growth of their data center business was a smidge under what was expected. Expectations were very high, and they were very close to meeting that, even very high expectation. Then they went on to say that the AI division will grow by a percentage in the very strong double digits this year, and this was in their conference call. In fact, they're expecting it to grow by 69% this year. Right. So this is hardly a disappointment in AI expectations about the demand for chips going forward. But again, if you just read the headline and then you go react to your position in your portfolio, it leads you to make bad decisions. So again, expectations were very, very high for AI at this point. So we've got to adjust those expectations a bit. And so Wall Street will start to temper those down a bit, which will, give these companies, a better shot at the next quarter of meeting or beating estimates. But again, when you're growing at 69% of anything, particularly companies this size, that is nothing but impressive. And this is why you have to, and a lot of people will take a look at NVIDIA and they'll go, well, NVIDIA is, extremely expensive because NVIDIA is trading at a PE, a trailing PE of, I'm actually going to pull up the number for you right now. They're a trailing PE of 47 times earnings, right? So that's obviously very, it used to trade at like 130 times earnings, but they're still trading at 47 times earnings. Their PEG ratio is below 1, which is price to earnings growth. That's because their earnings growth is growing so rapidly. So if you start taking a look at relative valuations, I went through this with Adam Taggart over the weekend when I talked with him. But you take a look at relative valuations on NVIDIA because of their earnings growth, and particularly you use with growth stocks something like price to earnings growth, which is the PEG ratio. That valuation is not nearly as expensive as people think it is when you're growing earnings at the rate that you're growing. So again, the point is whether you like the stocks or not, I don't care. But the point is that this is the problem we have in the markets right now, is that you've got too much media at you with all these headlines that are trying to, get clicks, views, etc., that can lead you to make bad decisions. So you've really got, and so it's becoming much more incumbent upon you to really do your homework, particularly if you're managing individual positions. Now, it doesn't mean ignore the data at all, but you have to separate out the data from the headlines. So anyway, again, those are the type of things you need to be careful of. All right, Danny, you've got an article that says, you sent me an article this morning. I've not had time to read it yet, so you're going to have to tell me what it says. The bond market is signaling two things about Trump's second term. So what's the bond market telling us about Trump's second term? And I'll see if I agree with him or not.
There's not much to say here, Lance.
Okay.
No, so, and this has been a conundrum for many people, and us included, in the sense of, the economic policy that we've continued to see and the challenges I think that it's presented in the sense of where yields are and where they're potentially going to go. And so we had a great question earlier about the yield curve being uninverted. Mm-hmm. What does that actually signal a recession? We've had a handful of leading economic indexes that have really been signaling this for some a long period of time. Probably some of the longer periods like leading economic index, the yield curve being inverted. All those things historically will signal a recession on the horizon. The question is how long does it take? And, I think the challenge that we face right now is that we're getting from an artificially stimulated economy in so many ways coming off of COVID with so much fiscal and monetary policy to an environment now where the economy must stand on its own two legs. And so we're at that point. We're seeing the yield curve make that bigger change. But I think the challenge now is, we have a tariff. Nope, there's no tariffs. What's the actual impact to growth? We're pushing these back by 30 days. And so the article is really presenting a couple of different issues. Do you remain in short-term treasuries? Or when is it time to actually begin to start to increase your duration a bit so you can take advantage of that? And, what many people I think are doing is they're waiting for that shoe to drop. The challenge will be is, the old saying is what? Yields take the escalator up, but historically will take the elevator down, so they come down much quicker. And that's going to be the challenge I think many people are presented with when looking at when do you increase that actual duration. You say, okay, well, listen, I may not get as much on yield. And now you actually can get a tad bit more than what we look at the short end of the curve. But when do you make that change? And do you go ahead and say, listen, I'm willing to lock this in, but I also understand the appreciation aspect of this. And while I may not hold it forever, the big question we get, we hold a 20-year duration bond. And people say, well, look, I'm 60 years old. I'm probably not going to make it to 80, or I'm 70. I'm not going to make it to 90. I'm like, whoa. We're not holding that for that time frame. Right. And I think that's a big misconception when we think about bonds, because some people do. And I know plenty of people that actually buy bonds say, I don't care where it is. I don't care about the price. All I care about is that it's going to pay me my income. I'm going to get the proceeds back, or my heirs will at a later date. Mm-hmm. And that's one way to look at it. Now, the other way you can look at it is, a little bit of speculation or the assumption that yields will go down over time and you're going to capture some upside potential here from the appreciation side. And that is the bigger differentiator between the short-term and long end of the curve. And so I think the challenge is that if you're in these short duration bonds, I talked to somebody earlier this week, they said, I just want to buy 3 and 6 month T-bills. Fine, fair enough. Well, here's the problem. What happens when rates fall? And now instead of you getting 4 and change, you get 3 or you get 2. And that's going to be the key is now the Fed has indicated, looks like they're going to slow down as far as, rate cuts at the moment. We've already seen 1 full percent since September. And this is where I feel like you're going to have a lot of that reinvestment risk. We haven't had so much of it as of yet. We've had a little bit, but we're going to see it much more substantial. And if you're needing these funds to live on, that's where the challenge is going to lie.
That's right. And it is. I mean, this is the whole thing, and also too, it's also important to have context around, why we own bonds is for a couple of reasons. One of, first of all, we have portfolios that don't own bonds, right? We have a dividend equity model that owns no bonds in it, and so if you want 100% equity exposure, that's completely fine, and you don't have to have it. But if you are trying to build you're looking at your financial plan and you're building a long-term portfolio to generate income, have market stability, protect you from downside risk, those type of things, you'll want to have bonds in your portfolio because bonds lower that volatility risk of the portfolio. So, yeah, we have portfolios that own bonds in them. They own them for a very specific reason, not just the income. And we've talked about if Danny meets with a client and says, look, you need a 4% hurdle rate, and we've gone through this math with you before, but if I need 4% to meet my hurdle, my goal for retirement, I don't need to take a bunch of risk. Because if I go from 4, if you say, well, Danny, just get me 5, I'll just, I'd be happy with 5%. That's fine. But that's a 25% increase in the rate of return you want. Just get that 1% additional rate of return is a 25% increase in the overall return of the portfolio and about 100% increase in the volatility risk you've got to take to generate that 1% additional rate of return. So you have to ask your question, is it worth it, right? Is it worth that much risk to generate 1 additional point? So if all I need is 4, split the portfolio in half, just make math really simple, 5% of my, a 5% yield on a 20-year treasury, easy math for this morning, I haven't had nearly enough coffee, 50% of the portfolio, that's 2.5% of income coming into the portfolio of that 4%. So now my equity portfolio, the other 50%, I build a dividend yielding portfolio that yields 2. That's another 1% in income. That's 4. We're now talking 3.5% of 4% of my total return I need for my portfolio just coming in income. Now I need to generate 0.5% from market returns to get my 4% year. So, it's important to understand that we don't own bonds specifically just for a trade. They provide a very strong foundation to building long-term stability and returns in portfolios and to help clients reach their financial goals.
Well, and that hedging opportunity is great too. Yeah. I mean, I think the problem is that we anchor to the most recent bias that we have. And, we go back to 2022, you see intermediate bonds down almost identical to what the S&P 500 was. And you see long-term bonds down about the same as the NASDAQ. That is so uncharacteristic that we have to go back the worst year in bonds since 1788. So I think people are thinking like, well, that's not always going to happen that way. And if we're going to see this great inflation, we're going to see, all this enormous growth, I'll take the growth. That's fine. Now, the challenge will be obviously is going to be the inflation aspect of it. But if you're going to see yields continue to rise, especially if you think about the debts and deficits that we have, that's where we're going to have a problem. And so what happens at that point? If we continue to see yields higher, we're going to likely break something at some point. You're going to see them drop. The yields will then drop quickly. Markets will have fallen. And that is where you get a little bit of a protection aspect to it and potential upside. So, it's got to think about it, not just one piece of a puzzle. We got to look at the whole thing and say, okay, well, this is a part of it. And here's the reason we're using it. Sometimes we do want those non-correlated assets. We want to have other areas that will provide you with, number one, income, safety, different types of things. Now, it does not always work, as we've seen, But I think we're getting closer and closer to that actually paying off.
That's right. And also, too, again, if you come in and want to be a client of ours and you don't want bonds in your portfolio, no problem.
Yeah, we've got plenty of ways to do that.
Absolutely. So that's all up to you. How much risk you're willing to take for how much return you want to get. Be right back from the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you thought retirement income was just stocks and bonds, let us help you understand how to rethink your approach. Our first Candid Coffee of 2025 has everything you wanted to know about income in retirement. Saturday, February 8th with Richard Rosso and Danny Ratliff. What else is there besides stocks and bonds? Is your retirement paycheck really diversified? Everything you wanted to know about income in retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So, it's interesting how times change, Danny. I mean, you're not as old as I am, but I'm sure when you were growing up, your parents said, "Don't get in a car with a stranger."
Oh yeah.
Yeah,
Yep.
And especially white vans with no windows on them. Don't get into those if they're offering candy. And then now we've evolved to this point. It's like we can order a stranger with a car to come pick us up off of our phone. And now we're moving to so that's not good enough, right? Because we have to actually pay drivers. And I think this is a really key thing we need to understand about where the future is going. So we don't really need drivers anymore. Uber just announced that they are opening up a wait list for Waymo rides in Austin. This is the driverless taxis. So now we're moving to robot taxis, which is cool, right? So now I'm not going to get into a car with a stranger. I'm just going to get into a car with no driver and watch a Roomba go around Austin trying to navigate, busy streets. So we'll see how this works out, and again, it'll be fine. I mean, these things will work at some point. Robot taxis will be away. But now we have to come back and talk about, well, now what do all the previous Uber drivers do for a living, right? Because now, as Uber or Lyft, I don't have to deal with employees. I don't have to deal with payroll. I don't have to, and again, a lot of people say, well, they'll still have drivers, and maybe they will, but the move to get rid of their human function will be top of priority for Uber and Lyft to get as many of these robot taxis out there as possible, because again, now I don't have to pay benefits. I don't have to pay wages. I don't have to do any of that, right? I can eliminate that whole cost. That just makes my business that much more profitable. So now the question becomes is who's going to be, what are they going to do for a living? And then the real question is will I get into a robot taxi to drive around I think I'm going to need a little bit more evidence that it works well first.
Yeah, I agree.
But again, extrapolate this out. When are robot planes coming out?
Ooh.
And would you get onto an airplane with no pilot? Just saying. Just saying.
Well, I think you run the risk of so many other things. And you think about all the security issues in general, just with technology. I mean, that's kind of scary too. You think about somebody hacks your Uber. Mm-hmm. I don't know. I think my wife would love it because, I always get that person from like way out of the country. So they always have such fascinating stories. Yeah. And she's like, you talk to all these people. I'm like, you learn so much. It's great. She's like, I just wish you'd stop. I did tell her though. I said, if you will know, like, all those, you see those memes that says, you'll know if I win the lottery,
you'll know.
There'll be signs.
Right.
My sign will be is I'll have a driver, right?
Right.
Houston traffic is so terrible. You waste so much time in traffic and you could get so much more done. So mine wouldn't be to talk to a driver, it'd be to work. But, I could see the benefit of a lot of that. And obviously from their perspective, from a productivity and revenue. But yeah, I think you're right. You're going to need a heck of a lot more evidence. And airplanes, I don't know, maybe would you or would you not be better off? Especially in light of what just happened.
Right. That's right.
I mean, you had the worst week in the airline industry, and I can't remember how long. That's scary.
Correct. And there's some very suspicious things that are going on. So that's a whole different conversation. So,
yep.
Anyway, you've got a Candid Coffee coming up Saturday.
We do. So we're going to be talking about retirement income or income in general. And, I think that there's so many different ways to recreate that paycheck. And unfortunately, we're probably only told about a handful of them. And so we're going to talk about all the different options and things that you can do to actually recreate that paycheck and think a little bit outside the box as well. We get a lot of questions on, a lot of different types of investments, anything from alternatives to annuities to different types of funds that create income. And so we're going to spend some time going through each different type, answering questions. Candid Coffee in general is designed to be, we created this during COVID. And it's kind of like an office hours, just an opportunity for people just to kind of shoot questions at us and get an off-the-cuff answer. And so we will still want to keep that aspect of it true to its name. And so we're going to allow you guys to answer questions or ask questions, which we will answer. But we're going to spend a little bit of time going through some things, and you guys will probably have quite a few more when we get done. We try to keep it at just about an hour, give or take. Obviously, Saturdays are busy days for everybody, and so want to be cognizant of y'all's time, but also make sure we're answering all the questions you have. So realinvestmentadvice.com, go to sign up, go to the events tab. We would love to see you there. It's, it'll be a fun time, as Lance would love this one. But, speaking of different types of things, and I think right now in the environment that we're in, we're beginning to see a lot more people kind of think outside the box. Mm-hmm. And, I briefly mentioned alternatives, and we've talked about we're creating a private credit fund, looking at some different things to just create other opportunities from not just your typical stocks and bonds portfolio to try to recreate that income. We've been getting a ton of questions about it here recently. And really, this is kind of one of those things that we've seen. There's opportunities there that I think that we can help people meet. And what would you say some of the biggest misconceptions people have, or maybe just they get too far over their skis when you start thinking about alternatives? Because there's a product for everything now.
That's right.
And that's where I think we have to be really, really cautious.
That's right. And again, this is why when you're thinking about investing and these type of things, a lot of people are very binary in their views, right? Mm-hmm. So it's like, I'm just going to buy stocks, right? I'm going to invest. I'm only going to buy stocks, or I'm only going to buy gold, or I'm only going to buy bonds, or whatever it is, right? People tend to be very binary because of either past experience. I bought something previously that did really well, and so I'm going to assume that that's always going to do well in the future, and that's not always the case. But this is why you want to have good diversification and things like alternative investments, stocks, bonds, real estate. And if you take a look at how high net worth investors are allocated, they have about 20% of their portfolio into the stock market. A big chunk of their portfolio, generally 30%, is generally in fixed income because of the safety and security of bonds and what they provide and the income stream. Another 20 to 30% is generally real estate of some sort. Another 15% or so is generally private equity, and that's where they're making investments into, private credit, private real estate, private companies, whatever those are. And then they have a good, healthy chunk of cash for opportunities. And the reason they're diversified that way is because it helps provide stable asset protection over time and growth. They're not risking it all in the casino of the stock market, right? So and this is the way when you start talking about retirement income and building your portfolio and creating these opportunities, is looking for things that can help provide growth of decent returns every year with stability. So again, there's a lot of areas in the private markets where you can generate 10, 11, 12% returns on an annual basis without a lot of volatility, because again, they don't price every day like the stock market does. So, what gets us as investors is we see the market's up, down every single day, and that volatility weighs on us. Well, you don't have that pricing volatility in private assets because they only price once a month or once a quarter, however they're priced. So you don't see that daily volatility of what's going on. You just see the kind of the growth of the asset over time. And so things like private credit, private real estate, private equity, those type of things tend to work out very well as a volatility reducer in portfolios with the ability to generate higher rates of return over time.
But is it truly a volatility reducer, or is it something like our home that we're just not seeing a statement on a day-to-day or evaluation?
That's the whole point, though. Yeah. If I'm looking at daily volatility of the portfolio, right? Yep. If I have an asset that doesn't price for a month, right, the volatility is reduced in the portfolio for that month. Now, at the end of the month, if that asset's had a big drop, right, you're going to have a big pop in volatility at the end of the month.
That's right.
But over the course of time, it does reduce volatility. So these day-to-day swings in the markets aren't weighing on you. And this is why people like real estate, because they go, well, I bought this house and over the last 20 years, it's just gone up in price. Well, you just didn't see the fact that it was going up and down in price every day because you weren't trying to price it for sale every day.
Well, right? Yeah, that's right. And you're not actually getting a physical statement or evaluation on a daily basis. And, it's funny. I've talked to a handful of people that have said, hey, I bought this property, done well, but by the time I take out taxes, the maintenance, and, all the other things associated with owning a piece of property or a home, they're like, yeah. And inflation, they're like, well, I probably didn't make nearly as much. It looks great, sounds good, but it's probably not the return when I actually go back and dissect it as what I could have gotten somewhere else, but it still went up. And it gives you peace of mind. And I think that's the big thing about looking at other types of assets. There are some areas that can provide you with guaranteed fixed income. There are areas that, bonds, that's another way, but you're going to see that fluctuation on a daily basis. Annuities are another way. The private credit, there are so many different ways to recreate this. And the idea is, though, you have to have a good understanding as far as what you can and can't do. I think a lot of people think of private equity or private credit and they think, oh, this is the best investment because this is what really wealthy people do. And there can be a lot of good for it. But you're going to kiss a lot of frogs in some ways on some of these types of deals, especially with private equity. A lot of these guys never get off the ground, or, I had a guy years ago who was kind of mentoring me, and he said, listen, when you look at any of this stuff, it's like Vegas money. You have to be prepared to be able to lose some. Now, you're going to hit one that's going to hit a grand slam, and that's going to offset these other ones that you may lose your shirt. But just you have to know that going in, and you can't go throw all your chips and push them into the middle of the table. I thought, wow, that's really sage and prudent advice. But unfortunately, I think that I've seen this happen. We're like, oh, my buddy's doing this, and they've always done well. And they literally throw all their chips at it, and it doesn't go how they anticipated.
Right.
That's what's scary.
Yeah, it is. And this is why you have to do your homework.
Yeah. But even with the best of homework and the best of intents, it can go wrong. So you have to be really cautious when it comes to some of those types of deals.
That's right. All right. Take a quick break. We won't take a quick break. We're done for the day.
I'll take a break.
We're going on a 24-hour break. We'll be back tomorrow morning with Michael Leibowitz. We're going to talk about money tomorrow. It's going to be about money and relative rotation in the markets. We're going to get into a lot of that stuff tomorrow with Michael Leibowitz. So tune in then. We'll see you then. Have a great day. And make sure and register for the upcoming Candid Coffee this weekend. Love to see you there. See you then.